You have seen the headlines, the ones that flash across your screen every few months with the same urgent typography. Markets at all-time highs. Investor optimism surges. This time is different. And because you are a thoughtful person who remembers the history books, another set of headlines also lingers in the back of your mind. The ones from the autumn of 1929, the ones that preceded a decade of economic devastation that reshaped an entire generation's relationship with money. You do not believe that history repeats itself in neat, predictable cycles. But you cannot shake the feeling that something about the current market environment carries a faint echo of that earlier era. Not in the details, but in the emotional texture, in the way people talk about stocks, in the proliferation of new financial products that no one fully understands, in the quiet dismissal of anyone who raises a cautious hand. You are not looking for a prediction, and you are certainly not looking for permission to panic, but you are looking for a framework to understand what the market is whispering beneath its confident roar. That framework begins with a careful, unemotional comparison between the late 1920s and today, not to scare you, but to teach you how to listen for patterns that transcend any single crash or boom. The core concept that links 1929 to the present is not a specific valuation, multiple, or a particular regulatory environment. It is the psychology of structural forgetting. Every generation of investors convinces itself that it has transcended the mistakes of its predecessors, that the new economy, the new technology, the new financial instruments have rendered old rules obsolete. In the 1920s, the new magic was the electrification of America, the rise of the automobile, and the invention of consumer credit on a mass scale. People believed that a permanent plateau of prosperity had arrived, and that belief fueled a speculative spiral that disconnected asset prices from underlying economic reality. Today, the new magic is artificial intelligence, digital currencies, fractionalized ownership of everything, and a financial system that has been backstopped by central banks for so long that many investors have never experienced a truly vicious bear market. The psychological mechanism at work is called recency bias, the tendency to overweight recent experience and underweight historical precedent. An investor who has seen stocks recover from every dip since 2009 assumes that dips are always buying opportunities. An investor in 1928 who had seen stocks recover from every panic since the 1890s assumed the same. The specific triggers are different, but the underlying human tendency to mistake the recent past for the permanent future is identical. To understand why this psychological parallel matters, you have to look at the mathematical signature of late-cycle markets, not just the heights they reach, but the structure of how they get there. In the 3 years leading up to the 1929 crash, the Dow Jones Industrial Average more than doubled, but the acceleration was not linear. The market would rally sharply, pause, consolidate, and then rally again, each new high pulling in a fresh wave of investors who had been waiting on the sidelines. What made the late 1920s distinctive was the explosion of margin buying, the practice of borrowing money to purchase stocks, often with as little as 10% down. By the summer of 1929, more than $8 billion in broker loans were outstanding, a staggering sum relative to the size of the economy, and the interest rates on those loans were rising as the Federal Reserve tried to cool the speculation. The modern parallel is not margin debt in the same literal form, though margin debt is high by historical standards, but the proliferation of leverage through derivatives, options, and synthetic products that allow investors to control large positions with very small amounts of capital. The specific numbers are different, but the systemic vulnerability is the same. When leverage is widespread and asset prices are elevated, a relatively small decline can trigger forced selling that accelerates into a much larger decline. Let us walk through the math of a leveraged market cycle without sensationalism, simply to illustrate the mechanical reality. Suppose an investor puts down $10,000 of their own money and borrows $90,000 to buy $100,000 worth of stocks. If the stocks rise 20%, the investor's position is worth $120,000. They owe $90,000, and their equity is $30,000, a 200% return on their $10,000 investment. That is the euphoria phase, when leverage amplifies gains and creates stories of ordinary people getting rich quickly. But if the stocks fall 20%, the position is worth $80,000. They still owe $90,000, and their equity is negative $10,000, meaning they have lost not only their original investment, but also owe money to the lender. In practice, the lender will issue a margin call long before that point, forcing the investor to put up more cash or sell shares. When many investors face margin calls at the same time, they all sell simultaneously, driving prices down further, triggering more margin calls, and creating a cascading collapse that has nothing to do with the underlying value of the companies. This is the mechanical heart of every major market crash, and it was the engine of 1929 just as it remains the hidden vulnerability of any highly leveraged market today. The psychological explanation for why leverage becomes so attractive at market peaks lies in a behavioral bias called the disposition effect, combined with social proof. When investors have made substantial paper profits, they become reluctant to sell because selling would lock in gains and force them to pay taxes. But more importantly, it would mean admitting that the party might end. Instead, they hold on and even add to their positions, convinced that the trend is their friend. At the same time, they see their neighbors, colleagues, and social media feeds filled with stories of people getting rich from the same assets, which creates a powerful social proof that the behavior is not only profitable, but also wise. The 1920s had shoeshine boys giving stock tips, and the 2020s have TikTok traders sharing screenshots of $100,000 options profits. The specific medium has changed, but the underlying social dynamics of speculative contagion have not. This is not a moral judgment. It is a description of how human groups behave when they believe they have found a sure thing. The only way to resist this contagion is not through superior intelligence, but through a deliberate, almost unnatural commitment to historical perspective. Now zoom out from individual psychology to the systemic mechanics of money creation and credit allocation. Because the 1929 parallel is not just about stock prices, it is about how money flows through the economy before, during, and after a speculative peak. In the 1920s, the Federal Reserve was a young institution still learning how to manage credit cycles. It raised interest rates in 1928 and 1929 to curb speculation, but the rate increases came too late and were too small to stop the momentum. When the crash finally came in October 1929, the Fed initially did nothing, believing that the stock market was separate from the real economy. That belief proved catastrophic as the crash destroyed collateral values, froze credit markets, and turned a severe recession into the Great Depression. The modern Federal Reserve has learned from that mistake and has intervened aggressively in every crisis since the 1987 crash, flooding the system with liquidity, cutting rates to zero, and backstopping key financial institutions. This is why many investors today believe that a 1929-style crash cannot happen again, because the central bank will always step in to save the market. But this belief itself creates a new form of moral hazard, the tendency to take greater risks because you believe you are protected from the downside. The more investors rely on the Fed put, the more leveraged and fragile the system becomes, and the more dramatic the eventual intervention would need to be. The mathematical breakdown of this moral hazard is subtle but important. If investors believe that the central bank will cut rates by 2% whenever the market falls 20%, Then the expected cost of a crash is lower than the historical average, which encourages higher leverage and narrower risk premiums. This behavior is perfectly rational at the individual level. If everyone else is being bailed out, you are at a competitive disadvantage if you are not taking similar risks. But at the systemic level, the collective effect is to build a house of cards that grows taller with each successive intervention. The 1929 parallel whispers not that a crash is imminent, but that the structural vulnerabilities that made 1929 possible, excessive leverage, social contagion, recency bias, and moral hazard, are all present in today's market cycle, even if the specific magnitudes and triggers are different. The whisper is not a prediction. It is a warning about the dangers of assuming that this time is genuinely different. Historical parallels beyond 1929 reinforce this caution. The 1973-1974 bear market, triggered by the oil shock and the collapse of the Bretton Woods system, saw the S&P 500 lose nearly half its value, and it took more than a decade for real returns to recover. The 2000 dot-com crash erased $7 trillion in market value, and the Nasdaq did not return to its peak for 15 years. The 2008 financial crisis, which was not a stock market crash but a credit crisis that infected the stock market, saw the S&P 500 fall 57% from peak to trough. In each case, the period leading up to the crash was characterized by a widespread belief that the old rules no longer applied, that new technologies or new financial structures had created a permanent high plateau. In each case, the belief was proven false not because markets are irrational, but because the mathematics of valuation and the mechanics of leverage are unforgiving. The dot-com bubble had internet stocks trading at hundreds of times earnings, justified by theories of exponential growth that never materialized. The housing bubble had mortgage-backed securities whose risks were hidden behind mathematical models that failed. Today's bubble, if one exists, will have its own unique justification, but the underlying pattern of overvaluation, leverage, and collective delusion will look familiar to any student of financial history. This brings us to the identity shift that this historical understanding demands. The conventional response to market cycles is either fear or greed. Either you sell everything at the first sign of trouble, or you chase momentum until the very top. Both responses are emotional, not analytical. The identity shift that comes from studying 1929 and its parallels is not about becoming a perma-bear or a perma-bull. It is about becoming a structural observer. Someone who watches the mechanics of leverage, sentiment, and credit without needing to predict the next turn. This means paying attention not to the price of a particular stock, but to the aggregate data that reveals the health of the system, margin debt levels, the ratio of household equity to total assets, insider selling patterns, the slope of the yield curve, and the spread between high-yield bonds and treasuries. These are not timing signals, they are diagnostic tools, like the gauges on an airplane dashboard that tell you whether the engine is running hot, even if the flight feels smooth. You do not need to jump out of the plane, but you do need to know that the gauges are worth checking. The calm, analytical response to the 1929 parallel is not to sell everything and hide your money in a mattress. That response has its own risks, including inflation and missed opportunities. The calm response is to recognize that the future is fundamentally uncertain and to structure your financial life accordingly. This means holding a diversified portfolio that can survive a severe downturn without forcing you to sell at the worst possible moment. It means keeping enough cash or short-term bonds to cover 3 to 5 years of living expenses so that you are never forced to sell stocks in a panic. It means being skeptical of any investment that requires leverage to generate attractive returns, because leverage works both ways. And it means cultivating the psychological discipline to ignore the social proof of speculative manias, to be comfortable with the boredom of underperforming during a bubble, Because the alternative is to chase returns into the teeth of a crash. These are not exciting strategies, and they will not make you rich quickly, but they are the strategies that have allowed patient, thoughtful investors to survive every market cycle since 1929, including the ones that wiped out the overconfident and the overleveraged. So you sit with the whisper of history, not as a prophecy of doom, but as a quiet reminder that markets are made of human beings. And human beings have not changed in their capacity for hope, greed, fear, and forgetting. The year 1929 is not a template that will repeat in identical form. The world is different in countless ways, but the underlying vulnerabilities that produce that crash are always present whenever leverage rises, valuations stretch, and investors convince themselves that the old rules have been repealed. You do not need to know whether this cycle ends next month or 5 years from now, and you do not need to make a dramatic bet on that timing. What you need is a clear, unsentimental understanding of where the risks are concentrated and a patient commitment to managing those risks without trying to outsmart the market. That understanding will not guarantee your financial safety, nothing can, but it will protect you from the most dangerous illusion of all, the belief that this time, for you, the music will never stop. And when the music does stop, as it always has and always will, you will still be standing, not because you predicted the moment, but because you never bet everything on the melody lasting forever.